Credit Clear's Q3 24 update has been released on the ASX this morning. We're joined by Andrew Smith, the CEO, Victor Pepler, the CFO, and Jason Serafino. Just admit everybody again. A few more people joining, but that looks like we're just about there. So, Andrew, over to you for the Q3 update.
Yep, welcome everyone. I have to bear with me a little bit today. I'm a tiny bit under the weather, so it's probably best to hear more from Victor and Jason. But just to give you the theme of today's presentation, as you can see, continued growth. That what we're seeing is continued growth with underpinned profitability and sustainable cash from operations. So what we're seeing is not just strong growth numbers, but those underpinned by strong financial cash generation as well. So another highlight that we're seeing is that traditionally Q3 has been more challenging for this type of sector, with January being a very, very slow month, not just due to the working days, but also the lag from Christmas. But what we actually saw is a huge amount of growth from prior corresponding period of 22%. So some really good highlights, one that certainly the executive team are very, very proud of, and we look forward to sharing you more details in the presentation.
Okay, I'll cover this slide here. Andrew's already mentioned great quarter, particularly pleasing to see revenue at a record high, 10.5 million, which is 22% higher than PCP. So we're quite pleased with that percentage increase year on year, particularly given that we're confident there's still upside potential in that number. We still have clients being onboarded who haven't yet commenced revenue or have started very slowly and will ramp up, as well as a very strong sales pipeline. Continue?
Yeah, just continue. I think there'll just be a few grumbles as they put themselves on mute.
Okay, and it's all the more Q3 is all the more pleasing given it's seasonally our weakest quarter, given it covers the holiday season through January and February. So again, we're quite pleased. And if you have a look at the chart there, you have a look at last year where we did dip into Q2 and Q3, which is not evident this year. So we've certainly turned that around as well. And with all that, heading into Q4, which is traditionally our strongest quarter, we expect a strong finish to the year there on the revenue line. Look, and notwithstanding our revenues growing at a good rate, we haven't taken our eye off expense management, where we continue to approach that in a very disciplined manner in order to expand our operational leverage and flow through to the bottom line. So we're looking at all aspects of the P&L there. So that's revenue tracking well, looking forward to a strong Q4, great pipeline, good clients coming on board. So all that is working well for us. Moving to cash from operations now. So like you can see from the graph, did drop a little bit on the last quarter, but still cash flow positive from operations of 200,000, an improvement of 800,000 on the previous corresponding quarter there. Remembering our cash runs 30 days in arrears to revenue. So March quarter cash would include the revenue months of December, January, and February. Again, 3 of our lowest revenue generating quarters. So despite all that, we still managed to produce a cash flow positive number from operations. And again, provided revenue continues to grow, we maintain expense management discipline. We expect cash flow to improve going forward there as well. And lastly, on this slide, cash at bank, still a very solid balance sheet, 12.4 million in the bank to fund growth. We're now strongly considering inorganic growth, looking at international markets. We had a look at the international markets a couple of years ago. We had some advisors overseas overseas. So we've learned a lot about
You're on mute, Victor.
Okay, we're good to go. So cash at bank, I'll just repeat that last bit. 12.4 in the bank there to fund growth. Focusing on inorganic and international markets. We're looking at international markets which have similar collection jurisdictions and reg requirements to the Australian market. I think we've proven that our business model is working in Australia, and we're ready to take that overseas. Remembering that digital collection platform that we've got, which produces higher collection rates, is transferable. So we'll look to get upside there with whatever targets we're looking at. And a reminder that, one of our key criteria in targeting international organisation is that they are cash flow positive, they are cash accretive, so that we are not depleting our cash reserves, with any potential acquisitions. So we're well placed there. So overall, there, great revenue, focus on expenses as well. Cash from operations still positive with a good balance in the bank. So we'll move to the next slide from here.
Yeah, Victor, I think that's a real highlight slide, and one that we want to really make an enforcement that not only are we growing fast, we're doing it in a disciplined way. I know there's someone on the call that sort of taught me about what a 4C was when I first took the job, and it hopefully won't be too long before we no longer need to issue 4C notices. So I think we're really, really happy with the fact that not only have we generated a good growth momentum, we've maintained our investment in technology, and we're actually spending a lot of time and money on onboarding new clients that we're yet to see upside from. So to have still produced those numbers whilst maintaining investment in certain growth, whether it be sales and marketing, onboarding, or tech development, I think is a real highlight for the quarter, and one that should give a lot of you confidence in what we're saying as a business we continue to deliver on.
I'll jump into this point. So thanks, Victor. So the fundamental that is underpinning these very strong results is the strategy for us to transform the experience of customers who are facing debt collection. And that's really what has changed over the last, 5 or plus years. We've always known that the industry was ripe for disruption. As anybody knows, you talk about debt collection, it's had a terrible reputation, that image of the guys with the baseball bats threatening customers. And what we've seen over the recent years is a material shift in expectations of the community about how customers are treated, regardless of whether they're overdue, right? So that change was really accelerated in COVID, where everybody, all of us, felt that kind of fear of financial uncertainty. And now we have the cost of living crisis. So enterprises now recognize that they really do need to change. They've got to provide a better experience. They're going to lose customers otherwise, or they're going to face the full force of regulators with fines, etc. But their challenge is that they've been underinvesting in the debt collection space, in their technology and people for so many years. So how do they quickly transform? And that's really where we come in. So by bringing together the 3 organizations that we have, we're able to provide solutions at every point in the debt life cycle, from just going due all the way through to legals. And we can rapidly onboard our clients. So you can outsource to Armour, and we can provide the market-leading digital solution for those customers who don't want an embarrassment of a phone call and they just want to deal with it on their phone. And we can provide the best people for those that don't. And then similarly, we can then provide a SaaS-based subscription product to our clients for the early stage to bring that same great experience to them there. And that proposition is really winning. It's winning sales, where we see the rapid sales figures that you're seeing. It's winning in terms of outperforming our competitors on the panels once we bring those customers on board. It's also transforming our operational leverage because digital is high GP margin. And then as the icing on the cake, we have then proven multiple times now that we can incorporate businesses and get that operational leverage, both with Armour and Oakbridge Credit Solutions before, and more recently with our DRA acquisition. So going to the numbers, they really speak for themselves. So we're winning clients at a record rate. Armour's tender win rate went from 30% prior to acquisition, which was also already fantastic, to a remarkable 70% now. We are proving we can rapidly digitize those clients with a record volume of digital payments. We're up 59% PCP. We're seeing the growth in revenue from those clients, which we were hoping to see in terms of we're achieving 79% of revenue expectations for the clients we've onboarded in FY23. And we, as Victor just said, we've still got a lot of dry powder there with large clients still in the onboarding and scaling phases as we've more recently signed them. We're seeing an increasing profitability with gross margins moving as we had hoped from 51 to 53% as we see more digital being applied into those clients. And we've still got a lot of work to do on the product side of things. As Andrew said, we continue to invest into the digital platform. There's plenty more to be done there. For example, in our insurance space, we've announced more recently a partnership with Guidewire. Guidewire is one of the largest, big international player actually, but one of the largest insurance platform providers. In fact, all of our biggest insurers here in Australia are on the Guidewire platform for their claims. And through our partnership, we will be able to have a plug-in into the Guidewire cloud platform that our clients can install the Credit Clear integration in one click with no tech people involved. And the result of that is that our clients can be using our digital platform to be able to engage with customers for claims. So whether it's being excess or third-party at fault claims, and see the results in the Guidewire platform in real time as those customers engage. So a really exciting upgrade to our partnership with Guidewire. And finally, the graph we've shown many times, I think this is the best representation of the digital transformation in effect, which is this is the value of payments that are happening on the digital platform. This is where customers have received our digital messages, they've clicked on those messages, they've made a payment or set up a payment plan. There's no human intervention involved in it. And once again, you can see the growth, it looks fantastic. So up 59% PCP, 29.6 million in this quarter. March was a fantastic month, a record. We broke 10 million for the first time. We in fact had the top 3 days on record, including the best single day of collections of 600,000 in one day, record in digital payments. And this is really the aha moment that our clients have and our internal teams have, is that moment where we've set up the completely automated digital engagement for them, and they just see those payments coming in 24/7 without them having to do something. And of course, we love them because it's 80% plus gross profit, and it's very, very sticky engagement with our clients.
I think very good point, Jason. And it sort of allowed us to be more profitable and reinvest that profit back into tech development and onboarding and growth. So whilst a lot of investors speak to me and the team here about, what if we stopped signing new clients? Would we become more and more profitable? As demonstrated by this graph, absolutely we would. But we're in that sort of really unique transition phase of the sector where we've got a lead and we want to scoop up as much market share as we can. We want to widen our reach internationally. And the way we're able to do that sustainably is through continuing to transfer old analog activities into digital. And this is a really good indicator that shows that's happening. Yep. So let's look at some other leading indicators across the business, which really highlight, the state of the economy and the state of Credit Clear as a key service provider to organisations that are involved in credit and accounts receivable. So what we're seeing is continued growth in the total amount of debt under management. So this is substantially up on prior corresponding period, not just in terms of number of files, but also the total value of files. Now, naturally, inflation figures will contribute to that, but what we're seeing is it's a very large amount of money, and certainly a large number of files that we've got under management to not just sort of deliver future revenue to us, but also improve the algorithms and the data that we're feeding into our AI, and continuing to figure out what the best method of collection is going to be moving forward, and improve our service levels to our clients and their customers. 83 new clients signed, and over 70% success rate on tenders. This is one that continues to, it's just surprised me. When I was Armour and we'd go for a tender, more often than not, we were just sort of disappointed. But each of the organisations that we're tendering for now are really looking for a new, innovative, progressive way to solve that challenging issue of a customer that maybe can't afford to pay or didn't have the time to deal with a small invoice. And what we've been able to demonstrate over and over and over again within tenders and proposals is that the unique offering of a digital solution supported by a traditional collections model, that A plus B is getting a much better result than our competition is able to deliver. And that's resulting in lots of new client acquisition. So we're really, really keen to continue that momentum, certainly into next financial year and beyond. But that's sort of some wonderful results that we're seeing off the back of that integration between the sort of three businesses. So clients building momentum, that end-to-end integrated offering that Jason discussed right at the beginning with sort of Credit Clear, Armour, Oakbridge, that is continued to win to the major clients. And we're sort of looking at major clients that sort of have an average revenue of over $1 million. So we've increased that by 2 tier 1 clients in Q3, which is an uplift from 16 to 18. So very, very, very happy to see 2 key clients, 1 in a quarter. Whereas, as I said in the past, I'd be happy if we won 1 every year, let alone every 6 months. So we're really seeing that accelerated growth through the acquisition phase. And quite frankly, we could not win any more clients and still see a huge runway of growth from those existing clients that are just being onboarded. Whilst it's challenging for the onboarding team, they've got over 20 new clients, key clients that we're onboarding at the moment. So you think about the resources that's going into that, where we're not really seeing a huge amount of revenue. So a bunch of tier 2 clients as well. So we've seen that increase from 39 to 42, 20% of our revenue from tier 2 clients, and a really, really good leading indicator for future revenue as well. So probably back repeating myself a little bit. So we've got clients already signed, building momentum, tier 1's clients, 2 not generating any revenue as yet. If we think that they could generate over $1 million worth of revenue in the coming years, that's a substantial amount of growth just in terms of tier 1 clients. 2 are onboarded and beginning to build momentum. And tier 2 clients, 6 not generating, and 8 are being onboarded at the moment. What we're seeing in terms of gross profit margin moving forward, and that's operational leverage, is that sort of plus 50% of revenue coming in from those new clients. We'd expect to see fall through to the bottom line and produce gross profit margins of above 50%. So very, very pleased about that. And, just highlights on the right, Credit Clear delivered a record revenue of $10.5 million in a quarter, which was up 22% on prior corresponding period. Once again, when I talk to the investment community, they're really looking for that sort of 20% plus growth number for, multiple valuations in terms of the stock. So we're really, really excited to see that number tip 20% and get to actually 22%. So we're really, really pleased on that. That should continue to deliver Credit Clear above and beyond our guidance. So we're really, really pleased about the way that the business is positioned right now. We've got great momentum. We've won the clients. I think we've got the technology and the people to start to drive gross profit margins. So we're really excited to see how we end up for the year. So, how does this really align to shareholder value? Naturally, we highlighted how we've performed over the last quarter from a share market perspective. I think lots and lots and lots of calls from investors, whether it be from institutions, founders, board members, who are all really pleased about the fact that we've been able to consistently deliver quarter-on-quarter growth with quarter-on-quarter cash generation. So I think that got the monkey off our back in terms of being a technology business that's burning through cash quarter-on-quarter, regularly needing to go to the market to raise money. I think that we've now got the confidence of the market back to maybe over-deliver on our promises rather than under-deliver. So that's starting to be reflected in terms of share valuation. And we're really, really proud of the fact that since this calendar year and the quarter, there's been substantial improvement in terms of share price. So it's hard to find friends when the share price is going down. And I think that now it's going in the right direction. We should be able to build confidence and attract some new investors to the stock.
I think, Andrew, just one more point there, which you touched on anyway. Since when we released our half year back in February, we referred to the inflection point. And just to let everyone on this call know, the conversations we've had with potential investors, existing investors, is very much a different tone of conversation to the point where many of those funds out there can see that we've got the right business model, we've converted to improved financials. And the point of this graph is all of that, as well as the conversations, have translated into an improved share price. You can see there, third bullet point left, we've put on, there's a large institutional investor who's certainly taken interest with a large shareholding. So that's a very different story to what we've had in the previous couple of years. So we're quite pleased that this is only the last 6 months, and we'd like to think that we can continue to deliver on what we have last few months there.
Yeah, and certainly those investors that have been with us a long time and had faith in that vision around digitising a very traditional industry. We're really, really proud of the fact that we can start to deliver on what those investors have been part of this organisation for. So we're really positive about the outlook. And I was only just listening this morning. We're still certainly in a challenging environment. Almost 8,000 insolvencies year to date. So that's sort of a real indicator that the economy's struggling as probably a bit of a hangover from the COVID stimulus payments. So we're still seeing an environment with relatively good unemployment, but people struggling from a cash flow perspective. So it almost feels like the perfect environment for us, where you've got consumers, customers, individuals, and companies that are challenged from a cash flow perspective and need to have a solution to help manage their cash flow. And that's where we really step in as either as a a digital solution or as a third-party agency to assist managing that process. And I think that that's going to continue to drive volume of work through from our existing client base, let alone new business. So organic growth, continue to see interest from materially larger clients from an end-to-end hybrid offering. So as Jason mentioned, we're sort of very much entrenched within the insurance sector, working with nearly all the major insurers in Australia, which gives us a perfect launching pad through technology partnerships and almost international relationships to go into markets like the UK and Europe or the US. So that's really exciting as well. We're also seeing, continued interest in people looking at software as a service as a viable option to potentially offshoring or onshoring physical teams. So having technology working alongside an internal collections team is certainly something that's growing momentum as well. And we're seeing more and more inquiries and opportunities within that space. And that's all contributing to a strong pipeline and growing list of tenders that we should be hopefully continue a 70% plus success rate and see our guidance expectations achieved. So overall, as a company, as a board, and as a management team, we're very, very pleased and proud of the result we've put together in Q3. It's traditional, a difficult quarter. When we set our budgets internally, we were sort of really quite strict on those, and yet we've overachieved on those budgets. So overall, the business is in a great spot with great momentum, and we're really excited to see what the future can bring, not just Q4.
Thanks very much. Excited indeed. We'll give this a try now. Anyone who would like to ask a question, if you could just unmute yourself. I can see who's unmuted, so I'll call out the names that are unmuted and we can go through a few questions. There is also the meeting chat if you would prefer to type your message out or your question out. Put that in the chat. We'll just see if anyone comes off mute.
As always, we're happy to sort of build individual meetings if anyone's really interested as well.
Absolutely, Andrew. Maybe Jason, just in the meantime, you mentioned the insurance sector and some of the work being done there. Do you want to maybe just elaborate a little bit on insurance and some of the success we're having there and the Guidewire partnership?
Yeah, for sure. So we maybe take a step back. The digital platform does a couple of things potentially in the insurance space. So, and obviously, I think probably everybody knows insurance is pretty underweight in terms of digital. So we saw a great opportunity to be involved in that space, and we made a partnership with one of the biggest insurers in Australia a number of years ago to bring digital to the insurance space. There's two major use cases. One is for insurers looking to chase their excess payments for their own customers and provide a digital way of doing that. And the other is third-party at-fault insurance. That's where their customer has been, crashed into by a third party, and those details were collected at the scene of an accident. And now that insurer needs to chase that third party to get their details, find out about whether they're insured or not, if they're insured, who with, do they accept fault, get a claim number, and ultimately, if they're not insured, then collect payment. And we've got the first, possibly in the world, I'm not sure, but solution to an entirely digital experience to do that. And it's been very, very successful. So we've seen, surprisingly, over 80% of those third parties will engage digitally. And of those that engaged, 88% will go on to complete the electronic version of that kind of questionnaire and go on to make payments digitally, which is a phenomenal result. So what we have is a digital solution that insurers want. They're sitting on a big and very a comprehensive and complex system called Guidewire, and we need to integrate those two things together. So in our partnership with Guidewire, we're building a plug into their cloud platform that can integrate the two together in real time with only a single, literally it's a single click of a button. And then for the users of Guidewire, for the operators who are in the claims team, they can actually see these customers and third parties engaging in real time through the digital platform through an automated process. So as the customers are, opening the links and starting to complete the details, they can see in real time those updates coming through to their platform, which just completely blows them away. Frankly, it's going from a kind of very archaic situation to a very, very progressive digital situation in a click of a button.
Yeah.
Very good.
I mean, it's also used to manage excess payments as well. So people are struggling to fund the cost of living, and when there's an accident which causes damage, even if they're insured, they're having challenges paying their excess. So, this is where, Credit Clear has been able to step in and help our insurance clients in other areas, not just in terms of third-party accidents, in terms of property damage to a vehicle, but helping in terms of sometimes premium payments or in terms of, excess payments. So it's an incredible industry where we've been able to sort of customize our product and service to support that industry. And, it's been really successful in terms of a strategy for us.
Yeah, and they're facing the same problem everybody's facing of trying to find staff, and their teams just being completely overloaded. So anything that can be done digitally is very, very attractive to them.
Very good. John Brennan, over to you. Please pose your question.
Thanks, Warwick. Andrew and team, congratulations on great progress, continued strength. Looks very right on track and in line with my expectations, so well done. Just like if you could give us some flavor how you see the market in terms of acquisition opportunities and whether you have any plans there. Thank you.
Yeah, very good question. The market is gone through some pretty incredible consolidation over the last couple of years. And I'm not sure if anyone was sort of following some of the acquisitions. One of our largest, or probably our largest competitor in this sector, was an organisation called Recoveries Corp, who merged with the old Dun & Bradstreet debt collection business called Milton Graham a few years ago. They actually were involved in a transaction, I think a couple of weeks ago. So there was already sort of been consolidation in that sector, and that was following the likes of Credit Corp acquiring Collection House, NCML, and previously Baycorp. So there's actually been lots of consolidation at the top end, and created some pretty strong tailwinds for a new progressive type of business like Credit Clear to step in and win market share in certainly Australia. So I think our organic growth in this current market in Australia is going to continue. But the success of the DRA acquisition gives us a lot of confidence that we can buy bolt-on businesses that are cash accretive, that we're buying on a multiple of earnings that is vastly less than what we're trading upon. So we're very much focused on looking at those opportunities as they present themselves, rather than sort of seeking out those in Australia. We've already got a bit of a challenge on our hands to sort of integrate all those brands and systems. However, where we're really interested in expanding, through acquisition is probably in two areas. One is into international, by looking at an acquisition, let's just say like an Armour Group in the UK or the US or somewhere else, that we can build the technology for them and hopefully have a blueprint to win more business, to drive profitability, and to improve customer experience in that market. From the research we've done, certainly in the UK and the US, we're still well ahead of the market in terms of technology offering. They're very traditional. So there's great opportunity there. And then the second area would be looking at technology bolt-ons that improve our service offering, whether it be in the payment space, whether it be looking at underlying software that can help us integrate with more third-party CRM systems and help deploy our technology quicker. So anything that sort of makes not just the financials look better, but also the boat go faster in terms of speed of acquisition, onboarding, and other areas. There is an exciting opportunity in the BPO space, and I say BPO, I mean business process outsourcing. With the DRA acquisition, we acquired a company called Nova Solutions, who offer collection services and BPO services to companies not just in Australia but internationally. So that, funnily enough, has been an area that we're asked quite a lot about during lots of our sales meetings with clients. So it's certainly an area that we're really looking at. Myself and the COO, Wayne Poynton, visited Manila to see the operations and looking at expanding that offering to our existing clients as well.
Thanks, Andrew. Couple of quick ones. Richard has asked if we foresee paying a dividend at some stage in the future if EBITDA keeps on increasing.
Look, once again, a very good question, and one that we probably haven't considered over the last 5 or 6 years. It's a good problem to have to decide that. I don't think we're sort of there in terms of our development as a business. We've got a real opportunity on our hands to continue to invest in SaaS. If you think about if we acquire a business in the UK, for example, we'll need to sort of deploy a technology team to build out that technology in that market, being hosted and customized to their regulations. There's just too much opportunity right now to suddenly turn the business into a dividend-paying stock. That's certainly my opinion, and it's certainly the board's opinion at this stage.
Fair enough. Michael has asked if we are looking at overseas expansion in the short or medium term. Maybe just a timing answer there, Andrew.
Yeah, look, I've got to be careful not to say too much, but it would be more focused at the current in terms of our goals to do it more short term. As I've said to the team, over the last couple of years, I think we needed to earn the right to show that the business is viable, can operate on our own steam, that this technology transformation is happening in Australia, and it's going to deliver a really good, profitable business. I think that we've done that now, and we can start to look offshore because we're confident that we've actually got a business model that works. Whereas it was always a fantastic idea. I don't think anyone would deny that digitizing a bunch of analog process in the debt collection world wasn't a good idea. No one really likes getting phone calls at awkward times. So the idea was always there, but how do we actually deploy it in terms of an effective economic model? I think we've really proven that now in Australia, and we can take that model internationally. So we'd love to do it sooner rather than later.
Very good. Shinichiro, the cash from operations this quarter is 0.2 million in total. For the year to date was 1.8. Are we still confident we can reach our EBITDA guidance of in excess of 3 million?
Yeah, we are confident. Remembering, Q3 is seasonally our weakest quarter. We're expecting a good fourth quarter. We've got clients coming on board. So the answer is yes. We still believe we can achieve our guidance, both revenue and underlying EBITDA.
Yeah, I mean, look, cash through the door is the last lagging indicator, isn't it, Victor? So if you're coming off the back of chasing money in terms of December, January, they're typically going to be harder months, not just to collect money from our own clients, but also typically low months. So as we go into Q4, we'd expect that to continue on improvement, and we're certainly here confident about hitting our guidance.
Very good. A question from Anoop. Back onto the Guidewire integration. Jason, is there a sort of revenue model? How has that been thought about, and is it being offered internationally?
Yeah, there is the SaaS component. So yeah, that primarily works on a pretty traditional kind of SaaS basis, subscription based plus utilization. To answer the question, and that is an entirely automated SaaS solution. So yes, and then internationally, well, it isn't offered yet, but as Andrew said, it can be. Maybe is the best way of describing that. Once we integrate it into that platform, it could be installed anywhere internationally, as long as we've got a version of the Credit Clear platform deployed and customized into that geography. So, you know, it's from a digital point of view, we're very much got a good runway to doing that.
Just to Ashley's question regarding naming some of the larger clients that we have won, and it being a particularly effective method of demonstrating and I guess you know, gaining credibility. Actually, you're right. We haven't done that in the last little while. We did at the end of the year last year release a full list of our major clients that we had won. It is an exercise for us to gain permission from all of them to be named publicly, but you're 100% right. It's something that we need to update. Andrew,
Ash, the way that it works in the best case is if you go to an individual client after you've won them to get their authority to use their name in a release around a tender win. They're not usually that keen, but if you send a release that has 30 or 40 key names on them to say, look, this is a release, we're going to the market, they're feeling less about the fact we're leveraging their brand to sort of promote our business. So that's probably the best indicator to say, look, if we've got you know, a release at the end of the financial year, we can look at those major wins that we've had, seek the permission from our key clients that we've won work with over the year to use their name. I think that there's going to be, you know, some wonderful news to come through in terms of, you know, key clients in that energy space, utilities, banking and finance, insurance. So we're really, really proud of those key clients from a name perspective, but it's sometimes a bit of a battle to get their permission from a client from a one-off basis.
It is. That leads us nearly to 10 o'clock. I think we've answered all the questions in the chat. I don't see anyone else. Chris.
Yeah, can I ask one quickly? And firstly, congrats on another solid quarter, guys. Nice to see some of the results coming through as they are. My quick question is around what do you see happening with regards to debt purchases versus the route that you take? Are we still seeing people move away from debt or selling underperforming books to debt purchases? Thanks.
Yeah, look, we've got lots of friends in the debt purchase world, you know, that actually use our technology, use our services, and you know, I'm always really keen to sort of get their view on the world. You know, there's certainly less people operating or less companies operating that space. It seems like there's Credit Corp, you know, Pioneer Credit, and then a few smaller operators, you know, Panthera, who were the second largest buyer of debt, are going through probably a much publicised, you know, some challenges. So what I'm seeing is that it's going to be very much monopolised by Credit Corp, and they'll dictate prices. And they're really the only buyers in the market that are buying everything from banking and finance, utilities, telco, you know, buy now, pay later, for example, whereas Pioneer Credit are very much focused on banking and finance only. They're not buying a lot of utilities debt. So there is less debt buyers in the market, and the price of that debt has come down significantly. Now, that should lend itself to organisations, you know, working closer with partnerships, whether it be traditional contingent collections businesses or organisations like Credit Clear, who can help them throughout that whole customer life cycle, from early stage intervention to late stage collections, or in fact litigation in some instances. So I'm personally seeing it, whilst, you know, clearly we're biased. We're definitely seeing it as an environment where it's good for us. But then again, it's probably good for the likes of Pioneer and Credit Corp, who have less competition, price of debt coming down as well. So, you know, I think that the organisations that have weathered this storm, that are still operating and existing, should be in for I think a good period of time for the next couple of years.
Thank you.
Well, thanks very much for joining us, everyone. This has been recorded. Recording will be circulated later today. As always, we're very happy to take any questions that you might have. And Andrew, perhaps a few concluding words?
Yeah, look, appreciate everyone sort of there taking the time for this call. I mean, it's great to sort of sit behind strong numbers again for the quarter. Appreciate, you know, everyone who's sort of been with the stock for a period of time, and those who are watching it, ready to sort of make a move. I think, you know, we're now heading in the right direction, certainly from a business perspective and also from a financial perspective. So, you know, reach out if you'd like a one-on-one and to find out a little bit more about, you know, the product or the service we offer, and you know, start to build a holding.
Thanks very much, everyone. The market is open. Have a good day. Bye.
Thanks, everybody. Bye.
Thank you.